for management to come.
Okay.
To all participants who've joined in today. We have the senior management team of HDFC Bank with us in our 28th CITIC CLSA Investor Forum 2021. Management team of HDFC Bank is represented by the CFO, Mr. Srinivasan Vaidyanathan, and Mr. Ajit Shetty, the head of investor relations. We will take investor queries. It's a large group format, so I'd request if participants can raise their hands and we will take questions from them. Before that, we had just 2-3 questions which are common questions, so we thought we would raise that up, Srini. Or if you want to start off with any opening remarks, Srini, over to you for opening remarks, and then we can start with Q&A.
We'll straight get into Q&A. We'll cover, I'm sure, everything we want to will be in some form we'll be covering. Go ahead. Yeah, start.
Perfect. So, thank you. So, Srini, one of the key questions that we get regarding the bank and the system is clearly system is credit growth constraint. Corporates are deleveraging. That's a place where HDFC Bank has gained a lot of size in the last few years. Retail is picking up, and as things normalize, it should kind of normalize back to the growth that we had seen earlier. And but for the bank of our size to deliver growth like what we've done pre-COVID, we need one more engine of strong growth. And in the last few months and quarters, the bank has spoken about how SME and commercial is going to be another very big engine of growth, right? So a few questions combined here. If you can address the growth aspect and the growth outlook for the bank in terms of one, corporate deleveraging and how that plays out for the bank, 2, retail normalization and how is the bank placed there, and 3, the grand plans on the SME and the commercial side.
Okay, perfect. It's several things into one. Firstly, thank you, Adarsh, and thank you for all others joining in today. We appreciate the opportunity to hear us. Thank you for that. Now, getting to your specific, this is a more broad, and then we get into the bank itself, right, in terms of what is happening in terms of the growth. In the context of the market, if you see, the demand in the past and during the COVID times, and now to the tail end, I'm using the word tail end of the COVID because of what we are seeing, and hopefully it is like that. The demand, the credit demand is far outstripping the supply, right? So which means there is enough for us to take what we want to take and leave out what we don't want. That has been the case in the past, and that has been the case now, right? It is our policy that constrains our credit architecture that determines how far we go and what we do. So it is not about whether there is enough kind of a credit that we can go and take. There is enough there. What we want to take is what we take, and we leave out the rest. So that's something in the context, and that is true across all segments, right? Across retail, SME, and wholesale, across all segments, there is enough kind of a demand which is there at what we want. Now, coming to the next aspect of it, how we have played and where we see it going, starting in the same order that you did, which is go with the wholesale segment. Yes, we participated in the wholesale segment over the past 3-4 years. We have been more so than in the past years, because we have been growing at 20 to 30% in the last few quarters, at least 6 to 8 quarters at least we have been, and all through the COVID. And it has been something that there are 2 things that were driving it initially, and then the COVID was driving it differently, which is, as we were getting into digitizing the API-based integration or host-to-host integration with the corporates for their cash management accounts and for their collection accounts, and broad-basing our kind of a product penetration from trade finance to FX to lending is one of the value proposition, and through that mechanism, we also get the salary account relationship of various corporates. So we get inroads into it, and we get the accounts of the key officials, and they are placed at the right kind of a segment of, call it the private bank as an example, for some of the officials, and then some of the employees are into our kind of an Imperia preferred banking, and then there are classic kind of customers who are in the other segments that we have. So across the spectrum, we do want the wholesale relationship, and we try to make a good deal of penetration. And if you see what followed from that, was the retail accounts. If I had to quote that, it's not necessarily exactly matched with that, but together it went to complement. In 2019, we had little more than 3 million retail liability relationships. In 2020, that is FY20, we had about 6 million liability relationships. FY21, 7 million liability relationships. And as we speak now, give that April to June quarter away, it was 1.6 million in the quarter, but they're running at the rate of little more than 2 million, call it 8 million or slightly more. That's a run rate at which we are trying to open liability relationships. So these are part of an integrated approach in terms of how you go after to get that. And a significant piece of that is the salary account that comes with it, right? So the wholesale is very important, and we focus on the high quality corporates, and we continue to focus, and our average rating continue to be on that. And where do we see this going? We see that the corporates in the recent times have stacked up on liquidity and now trying to bring down their liquidity needs, because they know what is COVID, at least fairly better than what they were knowing last March, last April. And their margins have been quite good. Internal cash generation is of a very high order. And corporates have taken this kind of a significant opportunity they all had to push the working capital down to the commercial segment, to the SME segment, to their supply chain segment, right, and distribution segment. And so that is part of what some pay downs and prepayments and pay downs of loans and dearth of high quality wholesale accounts are what we see. Still good growth, right? It's not in the 20s, a good double-digit type of growth. That's what we see. Not necessarily in the hyper 20s, 30s type of growth. So wholesale, somewhat lower than in recent past, but we continue to focus on high quality, reasonable growth. Then that takes you into the into the commercial and rural segment, commercial banking. So in order to tap that opportunity, which is 30 to 35% of the country's GDP is powered by that particular segment, SME segment. And the government rightfully so protected that segment very well through the COVID in the form of guarantee scheme and other kind of things that came along through the COVID, so that they are not wiped out. And this segment, in order to tap it with the corporates pushing down their working capital into these kind of credit into this segment, we moved people also to part of the Future Ready organization we announced in May. So we said, all right, let's get people who were doing the relationship banking with the corporates down to this commercial banking segment, a big bunch. And then we took some retail segment, which was dealing with small micro enterprises, and we put them into this segment. So we combined some of the segments from the wholesale, which were middle market, SME, and somewhere in the retail micro segment, and we put them in, and we call them the commercial and rural banking. And that we have seen even through the COVID, we saw good demand through the government guarantee scheme that came, and we saw that the first round of wave of the ECLSA scheme, we were one of the leaders. We gave about 25,000 crores or so was the loan disbursals that happened, but not necessarily the volume did not translate into a balance sheet size growth because some of these customers took the money and paid down their other working capital lines, right? So they took advantage of this and paid down that, which is all right. So they kept their open to buy so that when things resurrect and move along, they kept their powder dry to utilize it, and we were pretty all right with that. Right? So that's that segment positioned well. In the recent time periods, even in June quarter, they had quite a good growth, sequential growth of 4-5%. And we are seeing enough kind of a growth even as we speak now. And in the times to come, which is, if you think about the time period of 1 to 3 years, 3 to 5 years type of time period, we see enough kind of demand coming from that segment, because that's the significant backbone of the economy. And with the corporates also pushing down their working capital into this segment, we see enormous growth coming from this segment, and we are positioning ourselves very well to tap that. So that's the commercial segment. Within the commercial segment, if you see, there are two other things that we combined, which is the commercial transportation group, call that as the CV in short. We have seen that in the CV segment, during the crisis, there was enough problems they faced in the form of lack of ability to move, even intrastate or interstate, anywhere there was a movement restrictions, and so they were mostly grounded. Now that has come back to life, a lot of movements are taking place. Despite the hike in the gasoline prices, they are having the power to price. The freight rates are up in double digits, and which, if you talk to Rahul Shukla, he'll say how he is getting that in terms of the realization is pretty high. However, one way is very good, one way traffic. The other way, return, for good amount is empty right now, because the activity pickup is happened, but not in full-fledged form yet. Which we see that soon, in a month or two, that will pick up, and then it comes back to life, and then that is going to kick and run. And all of these customers in the SME segment, in the commercial vehicle segment, they're all small enough that this is their most important activity, and they enable the movement of various goods for various segments. So we feel that is a wonderful segment. A lot of these monolines see that the losses are pretty minimal. The lifetime losses are 20-30 basis points. Very attractive segment, and we are there, right? In terms of the rural segment, again, the 100,000 villages is where we participate in our farm loans, agri loans, and tractor finance, and so on. There are little more than 600,000 villages in the country. Now we are addressing that through a geographical expansion, saying we want to be in 200,000, 300,000 villages, not just 100,000. So we want to broad base it and move further into various constituents to have the financing. It's a targeted lending, and we do need to participate organically to grow. And so that is, again, one of the important and significant growth area that we perceive will come from there. Right? Then now that gets to the last one, which is the retail segment. Retail segment, again, constrained by policy, where we tightened the policy and came along. And slowly, as we are coming out of the COVID, we are getting to be little more normal. We are not at the normal stage of pre-wave 2 level. We are not at the pre-wave 2 level yet in terms of the policy, right? So that is the first stage. So we slowly moved in, but not fully there yet. But the volumes are quite good, and the selection seems to be reasonably great, which is tested by the recent vintage performance. Because all the marginal players who were having trouble with credit are no more qualified for credit. Either the bureau is showing them to be bad, or if they don't show good income levels and good cash flow generation, they don't become eligible, right? Our scoring models get them out. And so the first stage for us is to, with this tightened credit, we are able to get good traction. And as we go, as the economy comes back to greater life, we will go back to pre-wave 2, and then the next stop is to go to pre-COVID itself, right? There are 2 more steps to take. So we see enough demand there. It is for us to take, and across, I'm talking across both the unsecured and secured. And this is driven by, where I started this to say, the demand, the credit penetration in the economy, the credit penetration in the consumer segment is very, very low compared to another emerging economy or Western economy. The lifestyle of the people are trying to mimic the Western world. So that means the aspirations are pretty high, and they are trying to mimic the Western world. And so the consumer spending, which is 60% of the economy, is on the rise. It is going up. The ability, which is measured through per capita GDP, little more than $2,000 now, with the urban and metro little more than 3,000, and semi-urban and rural anywhere from 1,700 to 2,500, depending on which location, which tier 2, tier 3, tier 4 locations we measure, is moving up the curve and coming along. And the habits of the people with the ability is trying to get to that kind of a spending level, which is what we as a bank captured the last 5 to 10 years. If you see in the metro and urban, for most part we captured. Now we are trying to take that to the semi-urban and rural as that section, 60% of the population in that, and as that also matures from a per capita GDP and ability point of view, and their aspirations are already there and trying to get into what the metro is doing or what the Westerners are doing. So that's where we are trying to capture that. So there is enough demand from that, and we are positioned enough from our policy point of view to capture that.
Thank you.
I hope that
Srini.
gives you at least broadly what we are trying to think about on that here.
No, absolutely, Srini. I'll take one last question from my side and then have questions lined up from investors. Is in terms of technology and digital initiatives, you all have updated that you all have worked through the short-term and medium-term initiatives, and some long-term initiatives are underway. The RBI has released the bank from issuing cards, so the ban is gone now. Where are we on some of the long-term initiatives? What's the timeline there? And what outcomes should we as investors expect out of those long-term initiatives? One. And two, to club this with a CFO question on cost, right? There's an investment cycle in technology and digital initiatives in terms of the regulator nudging, fintech nudging banks to improve, banks themselves wanting to move to cloud. So there is an investment phase on the technology and digital side that banks will need to go through, right? Does that have an implication on the cost ratios? Because cost over the last decade, and HDFC Bank impeccably has been bringing down cost quite materially. Does that process take a break because we'll now be in a little bit of an investment mode? If you can answer those two, and then we'll take investor questions.
Perfect. Yeah. See, the way to think about it is that there has been a phase that the bank was one of the most digitized bank in the country from that sense, focused on digitization. What does that digitization mean, right? That we focused in the past, and now what are we focusing differently? In the past, it has been about, think about the digitization that happened in the data, in analytics, in credit algorithms, in the front-end decision making. The personal 10-second personal loan is an example, right? And so those are the kind of, and the process digitization for a straight through cost, bringing in cost efficiencies, right? So this is what has happened, and call that as digitization, as some tech expert would call it. That is a digitization that happened. And if you think about what is happening now from the long-term point of view, this is a digital transformation. That is what is happening, digital transformation as opposed to digitization. And in the later, this is the way where we are addressing it right now. It has got two sides to it. One is the digital factory approach, and the digital factory approach is addressing several of the front end customer touch point, customer journey. That means working with something like an Adobe to redefine the customer journey, working with another major partner to create the customer experience hub, right? And working with another tech startup to have a digital only bank. That means a digital savings account, digital cards, digital lending, a challenger type of a bank that challenges the traditional brick and mortar relationship based bank, challenger bank. And another kind of a front end aspect is the partnerships with the fintech players or other players in the market, tech majors in the market, taking us bank as a service into their platform and enabling digital DSA type of a model. So expanding our footprint and going to the customer where they are frequenting and bringing them over for our products, because we have all the products and services that we could offer, right? So these are 4 or 5 things that I could say that on one side is what we are trying to do. And this bunch of activity is what we call the digital factory. And I'll come to the overlying theme on that digital factory. Then the other leg to this is the enterprise factory. Enterprise factory is the core systems, the core banking systems that have evolved over the last 25 years, 27 years, which one has built on top of the other, deeply coupled monolithic architecture, old engineering process, right? That's what that is. If I have to define it in 2-3 sentences, that's what that is. Now we are trying to do, open them up, rewrite it, partner with the local tech players, tech startups, and recreate them into microservices, enable them in containers to be cloud ready. So this enterprise factory today, the core architecture is not even cloud ready, right? So you get them, put them in microservices, enable them on containers, and get them to be cloud ready. That is what and module by module. And then in the process, you decouple, right? Which are today, if you think about our mobile banking and net banking, they are closely coupled with each other. And so we're trying to decouple those kind of things and enable them into the new. And in order to do these things, there are a few, both enterprise factory or digital factory, there are a few things. One, people. In order to get the people, a new type of an approach, like the way 20 years ago, as a banking industry in the country, think about the treasury professional, think about the investment banking professionals, their career path, their compensation structure, their approach to work was uniquely defined to attract them into the organization. So same way, we have redefined tech professionals to attract the best into the organization from that sense. So this is all co-creation, as opposed to the old and traditional method of our tech people being consultants, getting the inputs from the business people, going outside to major tech developers, call it the TCS or the Backbase or the IBMs and so on and so forth, going to them to develop. Rather than that, our people co-create with various other players right now. So it's a different approach to getting things done. So one is the people. So we're redefining how we define the career path, the compensation, work culture of these people, so that they operate like the way they operate in a tech startup or in a kind of a tech major environment, including physical environment, as distinct from a traditional bank location environment for them to work, right? So that is one thing that we are trying to do. The second thing is the process itself, right? In terms of what is the kind of engineering that we use. Again, through partnerships with various tech majors. And if you think about the Google, the Amazon, or the Netflix, they all have latest technology. You will never see as a user, you will never see an outage. You will never see anything is down. But they do have outage, they do have downtime, but it is not known to any of us. But that is the technology that they do. And when they want to turn around something to deliver, overnight, you see that delivery. So we are trying to adopt the latest engineering, learning from these organizations, and trying to implement those engineering, which is continuous process of development, testing, and rollout. So you get that kind of an experience. The time to market is shortened. And again, it's all cloud-based from that sense. So these are some these are some of those things that are underpinning the digital factory or the enterprise factory in terms of the execution. Now, that's in terms of what are we trying to do on technology. So what does it mean? You should expect several products and services getting unfolded over a period of time, both on the enterprise factory and the digital factory one by one, including certain things that can come as early as in 2 months or 3 months time, partnerships, some of which we are already reading in the media, some of the partnerships are already unfurling to come along to take banking as a service to the other platforms to bring the customers in. So that is already ongoing. And so this is a journey that will take anywhere from in the digital factory 2-3 months onwards to various milestones. In the enterprise factory from 6-9 months onwards to 18 months, 24 months, 36 months, depending on each of the modules that we recreate or co-create into these kind of new technology algorithms. So that's where we are headed into. Your second part of the question that you asked, what does it mean to the cost and so on? See, before COVID, our cost to income was at 38, 39, right? And we have always maintained that directionally we are getting to mid 30s in the medium term to long term. We will be in the mid 30s due to not enough opportunities for us to spend because of retail is what consumes a lot of marketing, sales, and spending through the COVID period. We somehow landed at some 36, 37, right? That's not what we strategically landed. Tactically, it came into that kind of a 36, 37 cost to income. So we believe that the cost to income in the short term, as the volume starts to come up, as our activity starts to pick up, we'll get back to 38, 39. And in the short period of time, if it gets to 40, we will not be surprised because we want to spend as much as we can to get this back into great deal of traction. And we continue to maintain that over a medium term to long term, bringing this to mid 30s is the goal. And that is the trajectory that we are trying to drive to. And some of these things that we are trying to do are including the partnerships that we do, including the banking as a service to bring the customers into from the arena where they are playing onto the bank, and including unfurling the digital only bank. All of that is in the direction of having a lean cost approach. And the co-creation, rather than going to high maintenance, high AMC type of an application direction, co-creation is in the direction to keep the cost low, despite refurbishing everything and taking to the new technology or new engineering approach. And so the takeaway is that in the short term, you will see 38, 39 or even touching 40. And in the medium to long term, we continue to maintain that it will come back to mid 30s, again, aided by the scale and aided by the efficiency and aided by the one of the strategic pillars that we even put it in our annual report is the zero paper, zero touch, which is what is the theme across most of the things that we are trying to do now, will get us to that.
Thank you, Srini. That was very comprehensive. I'll start taking investor questions. So first one comes from Patrick Lemon from Rebecca. Patrick, do you want to go ahead?
Yeah, thanks. Yeah, well, obviously a lot has been said already. But what I sort of wonder, and I mean, maybe going back to the IT side once more, I was actually a bit surprised when I heard that the measures taken to HDFC Bank on the back of outages and not being allowed to issue credit cards, and of course recently that has been lifted, that ban, so that's great. But I always sort of had the impression that you were quite a bit ahead in terms of IT, also compared to the industry. And clearly, we've seen also problems with other banks, and the regulator has been very harsh, I think, on all this. And it's also surprising that I would say, mostly regulators have no clue about IT, let alone that they sort of put a ban on doing stuff because of outages. So what has happened exactly here in India, and what were the reasons that HDFC Bank was sort of facing these problems? And I guess the last question being, how long will it take before you are 100% cloud native, which seems to be the direction you need to go anyway, longer term?
Yes, okay. Very good point to segue into the other aspects of the technology. Yes, as you alluded to, the outages are common in the country, outside the country. You've seen several of the research reports that shows that we are not an outlier from an outage point of view. Outages do happen, and we have not promised that those outages will be zero, right? We cannot promise it. It can happen, and it will happen at any time, right? So we were not an outlier. We are not the worst in the industry in the country, nor when you globally benchmark with the various global banks, right? We are not. We are somewhere in the middle of the pack in terms of the outages. However, when you think about once an outage happens, how long it takes to recover, right? Our recovery time has been, call it a couple of hours, 2 hours to 3 hours to 4 hours, depending on the application, to recover back. Some of our peers and some on the global industry benchmarks say that they are able to recover much faster than us, right? So that is one thing. If outages are common and happens, and we are not an outlier, but once it happens, we take a little more time to come back. And so we have paid attention to that aspect. And that is part of various action plans that we put in place, which is to say, how do we have a monitoring mechanism that we can predict if an outage is going to happen because of the traffic buildup that is happening in the queue, in the network, or in the security layer, or in the application layer, and whatever layer? How do we have a monitoring mechanism? And number two, in terms of automating the orchestration, which is, we have a main production site and we have a disaster recovery site, and those sites have to be in sync all the time, right? We do have an automated tool that we own, but we have not implemented those tools, right? So we've taken this opportunity to get that implementation of this tool. We're in the process of getting that to perfection, and we have fine-tuned some of the applications to tune it down in a way that how 30 minutes, 40 minutes, we can get back on our feet, right? So that is something that we focused on, and we seem to be quite confident with those kind of changes that we have done on that front. The second thing is that while it has been a dramatic or drastic approach in terms of non-issuance of cards and so on and so forth, but instead of we took it positively instead of brooding over it, and took it positively to say that we as a bank set high standards in the country. We promise a lot to the customer. So we took it in the positive light to say, how do we be best and leading in this, not just in the middle of the pack? How do we be leading even in this, right? And so that is the CO tone setting to say, all right, we got this, and this is how we are going to take it, and we will be leading in this. And again, uniquely, that was part of the digital factory and the enterprise factory, is to, we took this time to strategically position us so that we continue to be leading in technology and implementation. So that's the second aspect of it. The third aspect, if you think about from the regulator perspective, we have Indian banks which have branches overseas, offices overseas. We have very minimal, but various other Indian banks have, right? In the jurisdiction of MAS, or in the jurisdiction of HKMA, or in the jurisdiction of FSA in London, or in OCC Fed in the US, and so on. And our regulators are have quite access to those reports and the inspections that happen for Indian bank entities in those jurisdictions, and in terms of the actions and in terms of the stringency with which the supervision happens. As you heard the governor also speak in a couple of occasions when people have asked, he said raising the bar and making it much more stringent, and strengthening the supervision process in terms of getting to be in the front to guide and drive certain changes that are required. And we have taken it positively to say, all right, now the drive to change is, if left to ourselves, some of the things that strategically on the technology front, which I said, the digital transformation front that we are trying to do, we would have taken our own time. It could have been a year out or 2 years out that we would have got into different kind of a thought process to drive this. But we got to it within 3-4 months to start to drive it in that kind of an approach. So we have taken it positively to say, all right, if anything, it has accelerated our process. It has driven us to greatness, and we will continue to lead the technology from this kind of an approach. So that's how we have taken. And then your last part is, how long does it take to be on the cloud? We are well on our way. It is in various phases. The digital factory that I talked about, where some of the journeys or some of the customer experience hub or the digital only type of bank or the partnerships or the wallet, the next version of the wallet and so on and so forth. When it gets implemented, when it gets done and implemented, and some of them are already live, it is cloud, right? It is straight on the cloud. The enterprise factory, which is co-creating to redo the core systems, is getting cloud ready, and progressively that will get in the cloud. And that will take starting 9 months, 12 months to 24 months. So there are several applications in queue to do in several forms. So in stages it will go. And the cloud that we are embracing is we have multi-cloud, which means we have the Google Cloud and we have the Amazon, and we are working through the Azure Cloud, multi-cloud, and a hybrid approach, which is we have our own also. So creating landing zones, creating the perimeter for our security, so that we keep that banking security top notch that the regulator needs and we need. Thankfully, touchwood, we have not had any kind of a IT security incident or issue that we need to worry about, and we don't want it. And so we multi-cloud hybrid approach, and progressively as the applications get co-created and redone, it will get into the cloud. So that's with a longer time frame, starting from now to all the way to 2 years, 3 years, and some applications could take longer. But as we do, progressively they get in. It's not a big bang, it is progressively getting in.
Maybe very quick, I mean, could you perhaps mention some of the partners, IT partners you use to move that to the cloud? Is it maybe, for example, a company like Encino? I mean, I don't know if you're familiar with that one, or are these more Indian-based IT players?
More Indian-based, and some of the Indian-based are unicorns listed overseas, but more Indian-based firms.
Okay.
Perfect. Thanks, Srini. Next question is from Zai. Zaijuan, do you want to go ahead with your question?
Yeah. Hey, Shane, thanks so much for the opportunity. Just switching tracks a bit on the the improvement on asset quality front. So given how things are happening on the ground, are we on track to see kind of almost normalized credit costs by maybe September quarter also?
No, not in September quarter. The way to think about it
sorry,
is like
December quarter. Sorry, my bad.
Yeah. Okay, no problem. I'll try to explain this to you. The way it is happening, collection efficiency, after we let it hang in April, May, due to the COVID impact of 17-18% of our people impacted, and the huge kind of a catastrophic events in the economy here, more than economic impact, people impact, health impact that happened. So there was a lot of swelling of various buckets along the way. June, people were back on feet, for most part, good efficiency from a collections point of view. July, better than June. August, better than July, right? From a current collections efficiency point of view. Now, certain buckets that have been swelled, it takes time to go and get that back on track, because still there are physical restrictions are there. In some states, even calling restrictions are there, right? So it is going to take time. We believe it will take 1 to 2 quarters to stabilize various buckets. But the current efficiency, collection of the current dues, perfectly in order, getting the past dues 1 to 2 quarters. And in the process, if we need to provide, we do, but we will have a recovery process, right? We have seen recoveries as high as 25 basis points, 27 basis points it touched, even the December quarter or something, 27 basis points. So we expect for most part, customers seems to be having good cash flows. Job losses we have not seen, and we see the recovery will happen as soon as we are able to reach out and get to the customer to get that. From a timing point of view, 1 to 2 quarters, yes, December is a good quarter to think about that it would. We believe by March quarter, it could well be back to pre-COVID level. If wave 3 doesn't even come into the cycle, we could well be by March quarter, everything is behind and we're operating like a pre-COVID type of level.
Got it. And on the the provision buffer, the excess provision front, how are we thinking about these? Are we already think that whatever we have made, including what we made in the first quarter, is already sufficient, given how things is turning out, if we see improvement on the ground, or we are still considering possibility of adding a little bit more to that buffer?
See, as a bank, we have remained as conservative as we can. And we made provisions. Even before COVID started, we made counter-cyclical provisions we were making. Even before that March quarter, March 20 was the first quarter of the COVID. Even before that, if you saw, we started to make provisions, right? Not that we knew COVID coming, we were taking the opportunity to make the provisions. And we evaluate this every quarter in terms of what is the provision and how do we handle this. And we continuously evaluate, right? So there is no preconceived notion that we have. But the theme that is, we'll operate in a conservative manner, and we will build provisions as needed and more than as needed to be resilient, to keep the balance sheet quite strong. We'll continue to do that. And so I, at this moment, even for September quarter, I don't have a preconceived notion of what we will do. But thematically, that's what, as a bank, that's how we have behaved, and that's how we will operate.
Got it. And if I can squeeze in last one, if I could, on the NIM front, last quarter we were impacted a bit by, a mix of different, factors. For example, like credit cards, revolvers, bingo. So how should we think about the trajectory of the NIM going forward? And has this kind of, mix impact, this pressure start to ease a bit?
To somewhat, it is eased a bit, all of those reasons that you mentioned, somewhat to some extent. But it will take 2 to 4 quarters, depending on at what speed the retail comes back to life, right? Retail is coming back with a good order right now, as the bookings are quite good right now. But as I said, with the still policy constraint, not at the pre-wave 2 level yet, right? But good bookings are coming through. So it will take 2 to 4 quarters for the mix to come. It has taken us 6 quarters for the mix to come the way it has come, right? So we believe that on the retail on the way up will be faster than on the way down, right? In terms of their mix. So when the retail mix gets back to the pre-COVID or the levels before, you will see the net interest margin also pick up and get there, and that includes cards, right? Rightfully so, the card revolvers are down. People who were impacted and didn't have the cash flow ability, either they are in the charge off or we have provided for them and curtailed. And we have significantly curtailed the credit lines on credit cards, right? We've still not opened up fully in terms of opening up the credit lines. There are revolvers, but we are cautionary, not allowing credit limit increase. Normally, every few months, sometimes a few weeks, depending on the customer segment, we will evaluate for credit lines. We have not done. We don't want to do now. We'll give it another month or so. And we periodically review this, both at the CEO level and at the credit level. Finance will participate in those reviews. We go through those reviews, and it will take probably another round or 2 rounds of kind of a watch by our credit before credit is an independent architecture. Nobody can influence in terms of what they do from a credit line approval point of view. Yes, we're still operating in an extremely tight credit line, credit granting approach, even on revolving cards, which are paying, even come through the crisis and extremely doing well. Credit lines are not available free for increase. So it will take another month or 2 before we do that. So the point is that 2 to 4 quarters, we need to wait for the retail to pick up, and then this would follow from there.
Got it. So it's safe to say that NIM front we will see gradual improvement, maybe 2 to 4 quarters to get back to where we were, maybe somewhere like last year.
Yeah, we believe so. Yeah.
Got it. Thanks so much.
And,
Thanks so much, Srini.
The retail is the one that is going to power that back.
Got it. Thank you.
Yeah. Thanks, Guy. Chamsol, do you want to go ahead with your question?
Sure. Thank you very much. Yes, I believe you can hear me now, right?
Yes.
Yes,
Yeah.
go ahead,
Yeah. So on the retail side, thank you for sharing some colors. The question I have is, so you're focusing on the distribution to rural and semi-urban areas, which we think is the right strategy, indeed. Just wonder what's the contribution from there? Like, say you're growing, I don't know, 100. How much is actually coming from there, and what do you expect going forward? What will be the contribution going forward?
Okay. The semi-urban and rural contribution is very benign, right? Is in low double digit, not even touch 20%, right? However, that is where the opportunity is, both from liability side as well as from the asset side. Liability side, because of the pockets of liquidity that are there in the public sector bank, call it idle funds, which are sitting there, which we want to tap with a good value proposition on the lending side. We are taking, and the per capita GDP, as I mentioned, in the semi-urban rural is past the threshold of what the metro and urban was 5-7 years ago when we participated. And so we are taking the same products, same kind of a credit algorithm, and getting on to the semi-urban and rural. And all it takes there is the reach, because you want to have the right kind of reach. And both from our branch expansion as well as the partnership. CSC is one partnership, and making our salespeople, which are uni-product salespeople, agri salespeople, SLI salespeople, which are uni salespeople, making them into a universal salespeople. So they don't do only agri loans and SLI loans, they do multi-product. So they operate as a bank ambassadors, not as a product ambassadors. And so these are the kind of approaches that we have taken to get that penetration into the rural segment. And both geographically as well as in terms of training our people to get the products to them. And all of this in a digitized manner. Even the CSC network, we have taken time to implement because it is through a digitized approach. The business facilitators provide the leads for various walk-ins that come into their offices, and it is digitally transmitted. The nearby branch hub and spoke, we have mapped the facilitators to our branches who go and consummate the lead and make it into a relationship. And business correspondents who operate like branches are also digitally connected with the bank to operate in a manner so that we keep the cost low, because it is huge geographic dispersion and the volumes needs to pick up. And so we're trying to take this approach cautiously and go. Yes, we do think that if you ask me, 60% of the country is there in the semi-urban and rural, with the very low penetration of credit. The credit deposit ratio in the semi-urban and rural is anywhere from 35% to 65%. Country as a whole, it's about 75% credit deposit ratio. But semi-urban and rural is very low, right? Metro and urban is pretty high, all the way from 75 to 125. So that is where we see greater opportunity, both from a credit point of view, and their aspirations are rising. And that's where we're trying to tap them.
Thank you very much. And can I just quickly touch on the IT, the cost angle? I mean, can you just remind me? I think I heard like you guys are spending like 8% of the total cost into the digitalization at the moment, and you like to increase it to like basically double to 16%. Is it the broadly right ballpark?
No, we have not. We don't give any outlooks, nor have we given any outlooks like that. What we have said is that IT spend at the rate of, call it 8 to 10% of the total cost is more or less in the ballpark of what some of the ratios you see in the emerging markets or some research houses. When we consult with the research houses, it's in ballpark in that kind of an area. That's where it is. Yes, will it ramp up? It will ramp up to some extent. But as I told you, we're trying to efficiently do it in the sense that when we have development cost and the kind of an amortization cost coming in, the maintenance cost should go down, because currently is third-party applications developed and there is an AMC that goes with it. And the new kind of approach, we are trying to see how we co-create, we own it, and so thereby certain other cost synergies, cost efficiencies come in. we optimize as much as we can. So there is a both a spend kind of a plan and also a save kind of a plan that goes with it. On a net basis, will we end up spending slightly more? We believe so. We'll end up spending slightly more. But how do we view that? We view that as a lowering of the cost of acquisition. What previously we may have had a cost of acquisition through a feet on street, where we would have had a cost of acquisition through a DSA or a dealer type of a channel. Now the cost of acquisition is in the form of a digitized cost per in the digitized cost in the elements of cost, right? So looking at purely tech as such is one of the lens through which you do, but the other lens through which you do is what is the cost of acquisition? What is the cost of service? So it is going to replace at another cost that we are talking about.
Perfect. Shini, and participants, others from CLSA, I just wanted to inform we'll take one last question, but our lines could get disconnected by 4:25. That's the setup of the investor forum call. So we probably squeeze in one last question from Olivier. You had a question earlier, if you want to take it up.
Yes, thank you very much. My question is, could you provide the rationale for your investment in HDFC Ergo, please? Thank you.
Okay. See, HDFC Ergo is we are
just a reminder, Shini, sorry to interrupt. We may lose the line at 4:25, so if you can just keep it short and thanks.
Yes, we will do. See, we are the largest distributor, and the manufacturers, unlike certain other countries, the manufacturer also have a good amount of profits, and we would have done this investment long ago, but there was an opportunity in the form of a price discovery. Recently, it happened. There was a trade that happened, and so in order to have an arm's length pricing, market observable pricing, there was an opportunity. And so the timing was such that since there was some other trades that were going on, and we were able to get that transparency in terms of pricing to capture on this opportunity that we could participate in since we are the largest distributor and we know that there are good amount of profits residual in the manufacturing, we're trying to capture that also to some extent. And this is purely a financial investment where we see good returns that are coming.
Perfect, Srini, thanks for that quick comment. Participants, I think we would anyways lose the line, so we would have to end the session here. I thank all participants for joining, and thank you, Srini and Ajit, for taking out time from your schedules. Thanks a lot, and it was a pleasure having you in the forum.
Thank you all for engaging with us. Appreciated the questions and the conversation with us. Yeah. Have a good day. Bye.
Thank you, Srini. Thank you, Ajit.